There's so much talk about putting money into Roth IRAs, converting money into Roth IRAs, that sometimes we don't ever actually get around to pulling money out of our Roth IRA. So in today's episode, we're going to talk about just that. When is it actually time to start living on Roth IRA funds so you can actually enjoy the tax-free nature of that account that you've built up? Today's episode is based on a listener question. This question says, could you do a show on when should you take withdrawals from your Roth account? I'm thinking it just comes down to tax control. If you have a year where you want to go on a big expensive trip, you'll want to control your taxes. Go up to a certain bracket in your traditional IRA withdrawal and then take the rest from your Roth. Maybe this is just obvious and doesn't need explanation. In general though, I would think you would always take from the traditional first, to a point as mentioned above, and then if or when the traditional IRA is depleted, you obviously only have your Roth left. But I also haven't started Social Security yet. That will throw another variable into the equation. Maybe the only difference is you can take even less from your traditional IRA when that starts. By then, I think you'd be done with the Roth conversions. In fact, that's another show. When should you stop doing Roth conversions? I would think it would be after you've gotten your RMDs down to a reasonable amount, again, taking Social Security into account. So great question here. And the question is this, is yes, there's so much focus and so much priority on doing this Roth thing. Build up your Roth tax-free bucket. When do you stop doing that? When do you actually start living on your Roth account? And there actually is a good answer for this. And so what I'm going to do today is I'm going to talk about what you should be looking at. I'm going to be talking about situations in which you should be spending down your Roth IRA. And then I'm going to be talking about a general framework for how I like to think about this to protect your overall plan, using your Roth account in a way as a very important insurance piece for your plan as a whole. So let's dive in. The first thing that I always want to look at before I actually look at should you spend money from your IRA or your Roth IRA, I like to look at your long-term tax projection. Look at it this way. If I'm just looking at this year, I'm probably looking at your IRA, your Roth IRA, your brokerage account, and you might look at that and say, okay, I'm going to pull some combination of all of these. Maybe you also have Social Security or other assets. And what you're looking at is you're just looking at this year's tax bracket. And you might say, I'm going to fill up the 12% bracket, or I might fill up the 22% or 24% or whatever it is. That's all you're looking at. You have a very incomplete picture. That's only one side of the equation. The other side of the equation is where you expect it to be in the future. Now, we have no idea where tax rates are going to be 10 years from now, 15 years from now, 20 years from now. But what we do have an idea of, or what we can project out, is what might your taxable income look like in the future. So for example, if today I knew that I could pull money out of my IRA and I would be in the 22% tax bracket, or I could pull money out of my Roth IRA and save money on taxes, meaning I don't pay 22 cents on the dollar for every dollar I pull from that, what would you recommend? If you're starting to think about it, it goes back to what I just said. You don't know. What you need to do is you need to compare that to where will I be in the future. So let's dive into that a bit deeper. Let's assume I'm 65 years old today, and I project out where am I actually going to be when I turn 75? Well, maybe when I'm 65 years old, I'm living on brokerage assets, I'm living on IRAs. That might put me in a certain tax bracket. But by the time I'm 75, Social Security has kicked in for me and a spouse. That's a fairly high income amount. Even though not all Social Security is included in your income that's taxable, Social Security is taxed up to a certain amount. Then I also have dividends and interest from my investment portfolio. Then I also, and this is key, will have required minimum distributions. Required minimum distributions are those amounts I'm going to have to take from my portfolio, my pre-tax portfolio specifically, whether I want to or need to or not. So for example, if I have $1 million in my IRA at that point, my required distribution is going to start at just under $40,000. What I have to do is I have to say, okay, based on that $40,000, that's income that whether I want to or not, I'm going to have to take. What does that look like when it's stacked on top of my Social Security benefit and my spouse's Social Security benefit if I'm married? What does that look like stacked on top of other potential income sources we have? Is that a pension? Is it dividends? Is it interest? I can start to project out what will that look like at 75? What might that look like at 80? What might that look like at 85? And typically what happens for people that have saved a majority of their retirement portfolio to pre-tax accounts, typically when you retire, you have something that's called a tax planning window. The tax planning windows in your working years, you might be in a much higher income tax bracket. Maybe you're in one of the top tax brackets. Then you retire. And because your expenses go down, or maybe some of the money you're living on is cash assets or brokerage assets, it's more tax efficient, your actual taxable income drops dramatically. And it stays low for some period of time. But then what happens is later on in retirement, Social Security starts. If you're married, it starts for your spouse as well. Required distributions start. If you're married, they start for your spouse as well. And so you have this tax planning window, this tax planning valley where you are in a high income tax bracket in your working years, In your future years, so 75 and beyond or 73 and beyond, depending upon your age, your tax bracket goes right back up. And in the meantime, in between, you have this valley or you have this window where you could be in a lower potential tax bracket. So that's always the first thing that I look at. Because if I'm in a 22% tax bracket today, but I know for a fact I'm going to be in, let's say, a 32% tax bracket in the future, I do not want to touch my Roth IRA. Instead, I would rather pull more money out of my IRA, my traditional IRA, or convert more money out of my traditional IRA because I can do so at a lower tax bracket today than I will be in the future. On the flip side, that example I gave of that tax pending window, that's not automatically relevant for everybody. Maybe you run these projections and maybe you realize you're not ever expected to be in a higher tax bracket. Maybe actually you expect your spending to go down over time, and because you won't have required distributions or you won't have substantial required distributions, you can actually take less and less money from your portfolio over time. Well, if that's the case, and go back to my same example, I'm in a 22% tax bracket today, but I know in the future I'll probably be in a 12% tax bracket, that could be a great reason to use your Roth IRA. I'm going to use my Roth IRA today because it's saving me 22 cents on the dollar, whereas in the future, if I were to use it, it would only be saving me 12 cents on the dollar. So I hope that what those examples illustrate is you need to have both an understanding of where are you today in terms of your taxable income and the tax impact of pulling money from different accounts, and more importantly, where you expected to be in the future. Even if this is just a best guess, because we don't know exactly what tax rates are going to be, still take that guess. It's better than nothing. So how do you have an understanding of where you are today? Where are you in the future? That's step one. Step two is this. Find that tax threshold. For example, if I go back to my example before, maybe that 22% bracket is my tax threshold, where if I'm ever in a year where I need to spend more money and I'm under that threshold, maybe I'll pull more money from my IRA or my 401k because I'm willing to pay 22% taxes on that because I know I'd pay taxes at a higher rate if I wait for the future. On the flip side, if I'm already exceeding that tax threshold, maybe, as this listener pointed out, I have a really big expense this year. I need to pull a whole bunch of money out of my pre-tax accounts, and I'm already exceeding that bracket, or I'm up to that bracket. If I need to take any more money out, that's when I might tap into the Roth IRA, because I'm exceeding that threshold where if I spent more today from my IRA or converted more from my IRA, I'd probably be paying more in taxes today than I would had I simply kicked that can down the road and pulled that money out at a later date. So to put it simply, find that tax threshold based upon what number am I willing to pay taxes up to, or what bracket am I willing to pay taxes up to. I will convert and or spend assets up until that bracket today. If at any point I'm starting to exceed that bracket, that's probably where I'm going to start leveraging or utilizing Roth assets. Now, I'm looking at this in a very binary way. I'm looking at just traditional IRAs versus Roth IRAs. In reality, a lot of you probably have brokerage accounts. Maybe you have cash accounts. You have things like Social Security or pensions that are maybe taxed differently. So the actual nuance here gets a little bit more in depth, but generally speaking, there could be somewhat of a tax threshold that helps you to guide those decisions of should I spend more money from my IRA account or my pre-tax accounts, or should I be taking money from Roth accounts? So using that information, let's lay out a general framework for when should you think about using Roth assets, spending Roth assets, as opposed to pulling more money from accounts that will be fully taxable, like pre-tax 401ks and IRAs. The first, and this is just a summary of what we just talked about, is if RMDs, if required minimum distributions, aren't projected to be an issue. Now, what on earth does that mean? Be an issue is very relative. What's an issue for one person might not be for another. The way I'm defining required distributions not being an issue is you're not going to be required to pull more out of your traditional IRA than you otherwise would have. So for example, let's go back to that example I used. If you have $1 million or you're expected to have $1 million in your traditional IRA by the time that you turn 75. Well, if I'm already expecting that I'm going to pull out $50,000, not because I'm required to, but because that's what I need in order to meet my living expense needs, well, now my required distribution is not an issue. The required distribution would be just under $40,000 in that year. Well, if I'm already taking $50,000, I've already satisfied the required minimum amount, so that's not going to be an issue. Now on the flip side, let's use an extreme example. Let's assume that $1 million is not $1 million, but it's $5 million. And I still only want to take out that $50,000 because that's all I need to do everything that I want to do. Well, $5 million. So if I've increased the value of this account, in this example, 5 times, what that also means is the required distribution is going to increase 5 times. Instead of being just under $40,000, it would now be just under $200,000. So now you can start to see how that would be an issue. I want $50,000, but I'm going to be required to take just under $200,000. The implications of that is that's probably going to push me into a higher tax bracket that I don't want to be in or need to be in, but because that required distribution, it's going to force me to be there. So what I'm seeing is the reverse of that, is if that's not going to be an issue for you, if you project out your required distribution and you say, you know what, that's not going to push me into a higher tax bracket and it's not going to force me to take more than I otherwise would have already taken from my IRA, might not be an issue. In those cases, maybe you don't need to keep building up your Roth accounts to start shifting money from these pre-tax accounts to Roth to avoid higher required distributions. There may be more of a case to spend Roth IRA assets today because they're not going to be as necessary for you in the future. The second instance in which it makes sense to spend Roth IRA assets today is when you want to smooth out your tax liability. So this is kind of like part B for what I just talked about. Knowing that required distributions in the future aren't expected to be a significant issue for you, now can you use those Roth assets to smooth out your tax bill today? Let's look at an example for what I mean by that. Let's assume that you're single and you want to spend $80,000 per year. Well, for 2025, keep in mind the standard deduction is $15,000. So you want to spend $80,000 per year and you have IRA assets and you have Roth IRA assets to work with. If you were to pull all $80,000 from your IRA, that would push you into the 22% marginal tax bracket. What that means is $80,000 comes from your IRA. You have a standard deduction of $15,000. So you deduct that from 80. You're now left with $65,000 of taxable income. $65,000 of taxable income pushes you into the 22% marginal tax bracket. More specifically, taxable income that's subject to ordinary income rates in excess of $48,475 is subject to 22% taxes at the federal level. So because you're sitting at $65,000 of taxable income, the difference between $48,475 and $65,000, those dollars there are all taxed at 22%. Well, if you're looking at this, and keep in mind, you have both IRA assets and Roth IRA assets, and you know that required distributions aren't expected to push you into a much higher tax bracket in the future, let's now use those Roth IRA assets today. That's not to say pull all $80,000 from your Roth IRA. That's probably not smart, but maybe consider doing something like this. Pull $63,000 from your IRA. And just keep in mind as we go through this example, this is not advice. I'm just going to use this as an example to illustrate a point here. But let's assume that you pulled $63,000 from your traditional IRA instead of the full $80,000. So $63,000, that's income that you now have that's contributing to that 80 total that you want. Of that $63,000, it's all taxable, but we now need to back out the deduction. We need to take out the standard deduction. $15,000 is still the standard deduction, which means $63,000 minus $15,000. What you get is $48,000 of taxable income so far. That $48,000 is at the top of the 12% tax bracket. Keep in mind, $48,475, single 2025 is what I'm looking at here. That is the threshold where anything below that is taxed at 12%. Anything above that is taxed at 22%. So what you've done here is you've filled up the 10% tax bracket. You filled up the 12% tax bracket. Now, that number between 63 and 80, that $17,000 difference here, that money can come from your Roth IRA. So what you've done, instead of being all or nothing, if you take everything from your IRA, it pushes you into the 22% bracket. If you take everything from the Roth IRA, you're in the 0% tax bracket. Usually the extremes are not the way you want to go. You want to be more balanced, you want to be more in the middle. So a combination of IRA assets, Roth IRA assets, understanding how the standard deduction is going to impact this, what you've done is you've filled up the 10%, the 12% brackets without going into the 22% bracket and essentially doubling, almost doubling your marginal tax rate by doing so. Now, I know some of you are already way ahead of me on this. Look, if you're pulling some money from your IRA and some from your Roth IRA, those numbers, even though they both add up to $80,000, it's not the same amount after taxes. Completely understand. I'm just illustrating a principle here. There's some more nuance and more details you'd actually have to go into if you were doing this for yourself. But that is how I would look at using Roth assets, is how do we smooth out our tax bill to stay under certain key thresholds by pulling some from our IRA, but also some from our Roth, and probably, most likely for many of you, also factoring in things like cash withdrawals, factoring in things like brokerage account withdrawals. That's where it gets a bit more nuanced, but the same principle applies here. Another instance where it makes sense to spend your Roth IRA assets earlier is if legacy planning is important to you, but you expect your heirs to be in a much lower tax bracket than you are. If that's the case, let's assume you're in the top tax bracket, to use a super simple, although extreme example, and your heirs are in the absolute lowest tax bracket. Passing on a Roth IRA to them isn't super valuable. They're already in an incredibly low tax bracket. The tax-free nature of the Roth, that's going to be somewhat squandered if you pass it to them. You are the one that needs the Roth assets in this case. You are the one that's already in the highest tax bracket. So every dollar, every extra marginal dollar you take from a traditional IRA or a 401k, you're taxed at 37% at the federal level. Well, wouldn't it be better if you pulled money from the Roth account as opposed to passing that dollar amount or passing on that account to children who are in a much lower tax bracket? So if that's the case, if your heirs are in a much lower tax bracket, it probably makes more sense for you to prioritize spending the Roth as opposed to trying to pass that down. In a somewhat similar vein, another instance where it makes sense for you to spend Roth assets is if a charity is a major beneficiary or even the full beneficiary of your retirement assets. Now, this one's actually a lot more interesting than just passing along assets. So if you do pass assets, I'll address that first and what you can also do while you're still living. Charities don't pay any taxes on any accounts that you leave them. That includes traditional IRAs. If you have $10 million in traditional IRA, so an extreme amount, if you pass that to a child or an heir, they would likely be paying taxes at the top tax rate because they're going to be forced to distribute that over the course of 10 years. That's going to push them to the highest tax bracket. That full $10 million, and I'm using an extreme example just to illustrate this point here, if that all went to a charity, the charity gets 100% of that completely tax-free. So again, if that's the case where you have IRA assets and Roth IRA assets and a charity is the majority beneficiary, you spend your Roth. Your Roth and your traditional IRA are the exact same impact to a charity. They don't pay taxes on either. So you might as well get the tax benefits from the Roth IRA as opposed to passing that on. Now, those benefits don't just exist when you pass away. One really powerful planning tool is if I go back to the example I talked about, of some people, if you have a large IRA, it's going to give you large required distributions. One powerful planning tool, if you are charitably inclined, and charitable giving is a big part of what you do, is called qualified charitable distributions. You can gift over $100,000 per year from your IRA directly to a charity, and it does not count against you having to pull that money out of your IRA, pay taxes, and then gift what's left over. So let's assume that you do have a big IRA. Let's assume that you have an IRA and it's valued at $2 million. And you know that your required distribution might be somewhere in the neighborhood of $80,000. You also have brokerage assets and Roth assets and other things that you're living on. So you're looking at the $80,000 saying, I don't really need that, and I don't want to have to pay the taxes on it, and I do want to gift to charity. Well, what you could do is you could take that $80,000, gift it right from your IRA to the charity. You don't pay any taxes on it. The charity gets the full impact of the $80,000. They get the full benefit, I should say. And that $80,000 never actually touches your tax return because it goes directly to the charity. Now, you do have to be 70 and a half years old to use a qualified charitable distribution. But if you're at that age, this can become a really powerful planning tool. So those are some specific details of when you might spend a Roth versus when you might try to spend or prioritize traditional IRA assets. But here's how I like to think about things. Not in every single instance, but for a lot of people, this way of thinking about it makes a lot of sense. The reality is, whether we want to acknowledge it or not, we have no idea where taxes are going to be 10 years from now, 15 years from now, 20 years from now. You can take some guesses, but at the end of the day, it's going to be just that. It's going to be a guess. So given the fact that we don't know where taxes are going to be, I like to think of Roth accounts, things like Roth conversions, Roth contributions. I like to think of it as a form of tax insurance. So what do I mean by tax insurance? Well, let me relate it to an actual insurance policy. I have a term life insurance policy on my life where if I pass away, my wife and kids, they have a lump sum of money that would allow them to be taken care of for the rest of their life. I hope that my term life insurance policy becomes a giant waste of money. I hope that policy expires and I look back and say, I just wasted several $1,000s paying for that because I never actually got anything out of it. Why do I wish that? Because it means I'm still alive. It means the outcome I would hope for has actually happened. If I don't make it past that term, I'm really glad I had it. If the outcome I'm hoping for doesn't play out, I'm really glad I had that policy because it protects my family. Think of Roth IRAs in the same way. If you end up doing a lot of Roth conversions and contributing to Roth accounts, and it ends up being a waste of money, it probably means that tax rates are lower, maybe even much lower, than you expected them to be in the future. So that kind of became a quote-unquote waste of money, but it means the rest of your plan is probably going better at that point. The rest of your plan is subject to less taxes, aka your overall plan is in a better place, even if these Roth conversions, these Roth contributions didn't actually save you anything taxes, net, all things considered. However, on the flip side, if taxes do go way up, well, then this is like that insurance policy. I have money in Roth accounts, I can pull that out tax-free, and I'm protected, at least to the extent that I have money in Roth accounts, from those tax hikes. So in many instances, that's how I like to view Roth IRAs. This is a big insurance policy that of course can't guarantee the success of your plan, but in many ways helps to, as close as possible, ensure success, to maximize the odds or the probability of success of your plan. That being the case, your Roth IRA is an account that we want to build up over time to be that insurance policy. And if you don't end up using it all, this is something that's a very tax efficient way to pass on money to your children, to friends, to heirs, whatever the case might be. So the specifics are different for everybody, but that is one framework, one way of looking at it that can be quite helpful, is not trying to get things perfectly right. Because trying to get things perfectly right means you can predict exactly where taxes are going to be every single year for the rest of your life, and you can predict exactly what your taxable income will be every single year for the rest of your life. Unless we can do that, we have to take the best guess possible based on thorough planning, based on thorough projections, and then make the decision that's both going to maximize tax-free wealth, but in many ways do so in a way that's designed to protect against what could possibly come. And if it ends up being somewhat of a quote-unquote waste of money, it means that things are probably going okay for us. So I hope that was helpful. If you're enjoying this show, if you're enjoying this episode, make sure that you subscribe, whether on YouTube, Spotify, Apple Podcasts. Make sure that you subscribe, leave a comment, let us know what you think. Thank you as always for watching, and we'll see you next time. Root Financial has not provided any compensation for and does not influence the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.